Most scalpers struggle because they spend the entire day staring at charts, searching for trading opportunities, and constantly chasing the market. But what if the problem is not your strategy? What if the real problem is the timing? In this video, I will show you a powerful trading strategy that works only during a specific time of the day. So instead of trading all day long, you only need 1 hour to open your charts, find your setup, take your trade, and leave the market with precision and less stress. Before we get started, here's exactly what you'll learn in this video. How to use liquidity sweeps to identify smart money manipulation. How to spot real institutional supply and demand zones. The specific 1-hour trading window where the best scalping opportunities appear. And how to trade with better timing instead of staring at charts all day long. By the end of this video, you'll understand how professional scalpers use timing and institutional footprints to find high-probability trading opportunities with more precision and less stress. If you enjoy this type of trading content and want to see more smart money trading strategies, make sure to like the video, subscribe to the channel, and turn on notifications to get notified whenever I upload a new trading lesson. With that being said, let's get started. The first concept this strategy is based on is liquidity sweeps. You already know this. You've seen the market break support or resistance, take liquidity, and then reverse. This is what you think is the strategy. Then comes the second concept, institutional zones. What most traders call supply and demand. You mark the zones, you wait for price to come back, and you expect a reaction. Again, this is what you think the strategy is. But here's the truth. That's not what you're missing. What you're missing is timing. Because the same setup at the wrong time will fail. And the same setup at the right time becomes a high probability trade. And this is the secret most scalpers never understand. The best scalpers in the world don't trade all day. They focus on a very small window of time, sometimes less than 1 hour, where the market offers the best opportunities. Think about it like fishing. A professional fisherman doesn't stay in the water all day. He wakes up at dawn, that one golden window where the fish are active and feeding. He catches what he needs and leaves. The trader who understands the market does exactly the same thing. You don't need to sit in front of your screen all day. The New York session open is your dawn. This is where institutions reveal their intentions, where liquidity gets taken, and where real moves begin. So this strategy is based on 3 things: liquidity sweeps, institutional zones, and most importantly, timing. We use liquidity sweeps and supply and demand to track institutional footprints, but only during the opening of the New York session. And once you understand this, you can apply the same logic to the London session, or even the Asian session as well. Now let me show you how to identify the opening of the New York session without any headache. First, open your chart on TradingView. Then click on Indicators and type Sessions. Now choose this free indicator, Sessions by JRFX Addict. Once you click on it, the indicator will appear on your chart. Next, open the settings. From there, remove the Asian and London sessions and increase the opacity of the red color used for the New York session. And that's it. The indicator will now clearly highlight the New York session on your chart, making it much easier to focus only on the most important trading window. Now let me show you exactly how it works. This is the US dollar and Canadian dollar on the 5-minute chart. As you can see, the market was clearly trending down before the new session opened. Here we have the most recent swing high and the most recent swing low. Now watch what happens next. As soon as the new session opens, the market retraces back, taps into this support level, breaks below it, and then closes back above it, creating a clear liquidity sweep. This move tells you that smart money is stepping in, taking liquidity below the lows, and potentially preparing for a reversal. So here's the setup. You enter at the close of the liquidity sweep candle. Place your stop loss below the low, and target the next key level. Now look at what happens next. Price moves exactly as expected and hits the target. Now look at another example. This is the Australian dollar and Canadian dollar on the 5-minute chart. As you can see, the market was trending up, creating a strong bullish move. Here, we have a clear demand zone. So you mark the zone and wait to see how price reacts during the New York session. Now watch what happens. As price returns to the demand zone, it gets rejected and shows clear signs of validation. This tells you that buyers are stepping in, defending the level, and the market is likely to continue higher. So here's the setup. You enter at the close of the confirmation candle. Place your stop loss below the zone, and target the next swing high. Now look at what happens next. Price moves exactly as expected and reaches the target. Now look at this chart example. This is the 10-year US Treasury note futures market. Here, we have the most recent swing low before the new session opens. Now watch what happens next. As the New York session begins, price breaks below this swing low, sweeps liquidity, and then closes back above it. This is a clear signal that smart money is stepping in. And this is where timing becomes important. You don't need to stay in front of your screen all day. The key moment is the New York Open. This is when institutions reveal their intentions. As you can see, within the first 30 minutes of the session, the market already shows its hand. A liquidity sweep followed by a potential move to the upside. So here's the setup. You enter at the close of the sweep candle. Place your stop loss below the liquidity and target the next key level. Once the trade is set, you let the market do the work. Now look at another example. This is the British pound and Canadian dollar on the 5-minute chart. As you can see, price reacts at this level and reverses, forming a clear resistance. The market then retraces back to the same level and rejects it again. Now we're approaching the New York session. Watch what happens next. As the session opens, price moves above the resistance, sweeps liquidity, and then closes back below it. This is a clear liquidity sweep, a trap for breakout traders. And this is your opportunity. So here's the setup. You enter at the close of the sweep candle. Place your stop loss above the high and target the next key level. Now look at what happens next. Price moves exactly as expected and reaches the target. This is the Australian dollar and US dollar on the 5-minute chart. As you can see, the market was trending down. Now, as the New York session begins, price starts moving up strongly, creating a clear demand zone. So you mark the zone and wait for price to return. Now watch what happens next. Price retraces back into the demand zone, sweeps liquidity, and forms a clear pin bar candlestick pattern. This is a strong buy signal, especially because it happens right at the beginning of the New York session. So here's the setup. You enter at the close of the confirmation candle. Place your stop loss below the low and target the next key level. Once the trade is set, you let the market do the work. And as you can see, price moves exactly as expected and reaches the target. Now let me show you 2 mistakes that can ruin your trading if you don't avoid them when using this strategy. The first mistake is thinking this strategy is a holy grail. Look at this chart example. This is the British pound and Japanese yen on the 5-minute chart. Here we have the most recent high and the most recent low before the New York session. Now watch what happens next. As the session opens, price moves up, breaks above the resistance, sweeps liquidity, and then closes back below it. This looks like a perfect setup. You feel confident, you feel excited. So you take the trade. You enter at the close of the candle. Place your stop loss above the high and target the next level. But then, the market starts moving against you. And this is where most traders make a critical mistake. Instead of accepting the loss, they move their stop loss, hoping the market will reverse. Now watch what happens next. Even after moving the stop, price continues higher and hits it. Instead of losing 2%, you lose more than 6% of your account. And this is how accounts get destroyed. If you had simply accepted the loss, you would still be in the game. Because in trading, discipline is what makes you profitable over the long run, not one single trade. And I'll show you exactly why in the next example. This is the US dollar and Swiss franc on the 5-minute chart. As you can see, This is the most recent swing low, and this is the most recent swing high before the New York session opens. Now watch what happens next. Price moves down, breaks below the support level, sweeps liquidity, and then closes back above it. This is a clear liquidity sweep. So you take the trade. You enter at the close of the candle. Place your stop loss below the low, and target the next level. And yes, the trade works. Price moves up and hits the target. You feel confident, you feel excited. But here's the problem. Look closely at this setup. The reward is less than 2 to 1 compared to the risk. And this is where most traders make a mistake. Because what matters is not how many trades you win. What matters is how much you win when you're right, and how much you lose when you're wrong. If you keep taking trades like this, you can win multiple times and still lose your entire account. That's why money management is everything. Let me ask you a simple question. What if I told you that you could lose more trades than you win and still make more money than the trader who wins 60% of the time? Look at this table. 2 traders, same account, $10,000 each, same risk per trade, $200. Everything is the same, except one thing. Trader A targets $150 on every trade. His risk-reward ratio is 0.75 to 1. He wins 60% of his trades, 12 wins out of 20. Most people would be happy with that. But look at his final result. After 20 trades, only $200 profit. Now look at Trader B. Trader B only takes trades where he can make at least $400 for every $200 he risks. That is a 2 to 1 risk-reward ratio. He wins only 40% of his trades, 8 wins out of 20. He loses more trades than he wins, and yet $800 profit, 4 times more than Trader A. Same account, same risk, more losses, more profit. This is the single most important concept in trading, and most traders never learn it. Here is the rule. Before you enter any trade, ask yourself one question. Is my target at least 2 times bigger than my stop loss? If the answer is no, you do not take the trade. You wait for a better setup. Because it is not about how many trades you win. It is about how much you make when you win versus how much you lose when you lose. Trader A wins more, Trader B earns more. Never confuse the two. Now, we already know how to use liquidity sweeps and supply and demand zones to track institutional footprints during the opening of the New York session. But here's the real question. How do you separate a real institutional footprint from a fake one? Now, what about the liquidity sweep? How do you know whether it is a valid institutional footprint or just a fake move? This is important because not every liquidity sweep leads to a reversal. Some sweeps are created by smart money. Others are simply normal market fluctuations. And this is where professional traders separate themselves from beginners. Now, there are different types of liquidity sweeps you need to understand. The first type, liquidity sweep with a long wick. This is the fastest type of liquidity sweep. The market quickly breaks above or below a key level, grabs liquidity, and then immediately rejects the move during the same trading session. As a result, a long wick is formed. This is a strong sign that the breakout failed and that institutions may have trapped traders before reversing the market. This type of sweep is very common during the opening of the New York session because volatility is high and institutions move aggressively. The second type, one candle liquidity sweep. In this setup, the market breaks the level with one strong candle during the trading session. Then immediately after, an opposite candle appears and closes back above or below the level. This type of liquidity sweep is more controlled and deliberate. It reflects a well-thought-out institutional move designed to manipulate breakout traders before reversing price. This setup is powerful because the market first creates the illusion of continuation, then suddenly changes direction. The third type, multi-candle liquidity sweep. This is one of the strongest forms of liquidity manipulation. Instead of creating the sweep with one candle, the market slowly pushes beyond the level using multiple candles. This movement encourages more traders to believe the breakout is real. More breakout traders enter the market. More stop losses get triggered. And then suddenly, the market reverses aggressively and closes back above or below the level. This type of sweep is extremely powerful because the liquidity trap becomes very clear. The market spends time building the illusion before attacking in the opposite direction. And this is exactly how institutions trap emotional traders. Now let's talk about weak liquidity sweeps. If the sweep forms with a tiny wick, weak rejection, small candles, or no strong momentum shift, then the move is often meaningless. Sometimes, this is nothing more than normal price fluctuation. Remember, a real institutional liquidity sweep usually creates strong rejection, emotional trapping, volatility, and a clear reaction from the market. Weak sweeps without conviction should be ignored, because the goal is not to trade every sweep. The goal is to trade only the sweeps that reveal clear institutional intent. Now look at this chart example. This is the British pound and Japanese yen on the 5-minute chart. This is the most recent major swing high, and this is the most recent major swing low. Now look at what happens next. The market retraces back, breaks above the resistance level, and then suddenly closes back below it. This is a valid institutional footprint created by a long wick liquidity sweep. The move is fast, sharp, and aggressive. This tells us that the breakout failed and that buyers were trapped above resistance. So this is where you can execute the trade. You place your entry at the close of the rejection candle. Your stop loss goes above the wick, and your target is the next major swing low. Now look at what happens next. As you can see, the market drops directly into the target. But now pay attention carefully. Look at what happens next. The market breaks below the most recent swing low, which acts as a support level. But instead of continuing downward, price suddenly reverses and closes back above the level. This is a liquidity sweep formed with multiple candles. And this is one of the strongest types of institutional manipulation. Why? Because the market spends time below the level, convincing traders that the breakout is real. More sellers enter the market. More stop losses get triggered. And then institutions reverse the market in the opposite direction. Now think about this. Even if you missed the first setup, just 1 hour and a half later, the market provided another high-quality opportunity. So once again, you place your entry at the close of the confirmation candle. Your stop loss goes below the liquidity sweep, and your target is the next key level. Now look at what happens next. As you can see, the market moves upward exactly as expected. So what does this teach you? When you are present during the right trading session, especially the opening of the New York session, the market can provide multiple high-probability opportunities within a very short period of time. Not because you are forcing trades, but because you are trading when institutions are most active. Now let's move to the second institutional footprint, supply and demand zones. But here's the important question. How do you know whether a supply or demand zone is a real institutional footprint or just a fake move? Because not every zone is created by smart money. Some zones are backed by strong institutional activity. Others are simply weak market reactions with no real momentum behind them. And if you don't know how to filter these zones correctly, you will end up taking low-quality trades without even realizing it. Let's break down the key filters professional traders use to identify high-probability institutional supply and demand zones. Filter number 1, momentum imbalance. Real institutional zones are usually created with speed and authority. When smart money enters the market, price doesn't move slowly. It explodes. That's why you should pay close attention to the momentum leaving the zone. If price leaves aggressively with strong directional candles and very little hesitation, that's a sign institutions may be behind the move. But if price moves away slowly with messy candles, long wicks, and weak momentum, that usually means the market lacks commitment. And weak commitment creates weak zones. So the stronger the displacement, the stronger the footprint. Filter number 2, freshness of the zone. This is one of the most important filters. Only trade fresh zones that have not been touched before. Why? Because the first revisit is usually the most explosive. The more a zone gets tested, the weaker it becomes. Think about it like this. Every time price revisits a zone, orders inside that zone get consumed. And eventually, the zone loses its strength. This is especially important on the 5-minute chart because the market creates many weak zones during the session. This filter helps you eliminate low-quality setups. Filter number 3, break of structure. High-quality institutional zones often form after price breaks a significant level. For example, a previous high, a previous low, resistance or support. And this is important because that breakout is usually not random. It's often a move designed to grab liquidity, trap breakout traders, trigger stop losses, and shift market structure. When a supply or demand zone forms after a strong break of structure, it becomes a strong clue that institutions are active in the market. And that's exactly the type of zone you want to focus on. Filter number 4, risk to reward ratio. Never trade a zone unless the setup offers at least a 2-to-1 reward to risk ratio, even if the setup looks perfect. Why? Because risk management is what keeps traders profitable long term. A bad reward to risk ratio can destroy your edge over time. Professional traders understand something beginners ignore. You do not need to win every trade. You simply need your winners to be bigger than your losers. That's how consistency is built. Now look at this chart example. This is the euro and US dollar on the 5-minute chart. As you can see, the beginning of the New York session is characterized by a strong impulsive move to the upside. This immediately catches our attention because aggressive moves like this often reveal institutional activity. And this is exactly where we start looking for an institutional footprint. Now let's draw our demand zone. Perfect, but here's the important question. Is this a valid institutional zone or just another weak setup? Let's apply our filters. First, momentum imbalance. As you can see, price leaves the zone aggressively with large bullish candles and very little hesitation. This tells us that strong buyers are likely behind the move. The second filter is freshness. Notice that the zone is still untouched. Price has not revisited it yet, which means the zone still has a high probability of reacting on the first test. Now let's move to the third filter, market structure shift. As you can see, the market breaks above this previous resistance level with strong momentum. This is important because institutional moves often create structural shifts in the market. The breakout confirms that buyers are in control. And finally, let's evaluate the trade efficiency. As you can see, this setup offers a very strong reward to risk ratio of nearly 4-to-1. That means the potential reward clearly justifies the risk. Now this is where most traders complicate trading. But trading does not have to be complicated. You opened your charts before the New York session. You stayed patient. And after waiting just 1 hour, only 1 hour, the market delivered a high-quality opportunity. You place your entry, your stop loss, your target, and then you let the trade work. Do whatever you want, but do not sit in front of your charts all day long. Because the more time traders spend staring at charts, the more emotional and impulsive they become. And that's exactly where unnecessary mistakes begin. Now, if you enjoyed this video and learned something valuable, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next trading lesson. Thanks for watching, and I'll see you in the next video.